Welcome back to Turning Hard Times to Good Times. I am your host, Jay Taylor, and I'm really pleased to have with us once again John Rubino, a good friend of mine, and he has actually hosted this show on a couple of occasions. A really great guy, very well in tune with the financial markets and with what's going on in the world, even though he lives in Idaho. I must say, living in New York City, it seems like I should know what's going on, but John seems to have a better beat on things than I do in many respects, at least in terms of the markets, and that's why we like to have him on with us. Thanks for joining me again, John.
Hey, Jay. Yeah, you should have a better handle on things than me. Aren't you on the stock exchange watching what goes on?
Well, I live in Queens, so I'm not down there near Wall Street or Broad Street or Water Street or some of those places where I used to work at times. But, John, I want to ask you, 1 month is gone already. It's just gone so fast, the first month of 2019. But what is your take? How are you viewing things as we begin this new year now, as far as the economy goes? Do you see economic growth continuing this year? Do you see inflation picking up, possibly employment, unemployment? How does the economy look to you as we start this new year?
Well, we learned a really important lesson in 2018, which is the Fed cannot raise interest rates beyond current levels without causing the markets to completely freak out.
Yeah.
And, you and I have talked about this for the past few years, right? Rising interest rates in an over-indebted system is a death sentence because it pushes up everybody's interest cost. And everybody is so indebted that their interest costs are already pretty high. And if they go up because the average interest rate rises, then that breaks their budget, whether it's a government or a corporation or an individual, and causes chaos in the world. And we started to see that. We had a bear market just emerge out of nowhere in October and November of last year. And then it bottomed in December. The Fed announced that, never mind about further interest rate increases, and in fact, never mind about quantitative tightening. We will stop the balance sheet from shrinking by allowing bonds to mature and run off. And that placated the markets a little bit, but the damage is already done on two levels. One is that interest rates are already high enough to cause trouble. Corporate profit expectations have dropped below zero growth already for the coming year. And U.S. stocks are priced on the premise of strong earnings growth forever. So that's a danger out there. And, a lot of that is because of interest rates going up, which raises corporate borrowing costs. And the other is, as I said, we know the Fed is out of ammo now. We found out what they can do without destroying the leveraged speculating community and the rest of the financial markets. So now they don't have any way to rein in rising inflation or any kind of instability out there. So to the extent that the financial markets stay stable now and the economy continues to grow, then the Fed has nothing left with which to fight inflation going forward. And that's a big problem out there. So the short answer is, whatever we do, we've got a giant crisis out there. We just don't know exactly which crisis it will be and when it'll hit, but we have no ammo left to stabilize things when the time comes.
Mm-hmm. Yeah, and I've always sort of viewed it increasingly over the decades as we've gone deeper and deeper into debt. The debt to GDP has continued to rise almost exponentially. Debt relative to GDP is growing dramatically. And so it seems to me that we're perched on the edge of a knife, John. Almost one side, you could take us into a deflationary depression, another could be a hyperinflationary situation. In either case, it's a depression the way it looks to me. Do you agree with that?
Oh yeah, one or the other. Because what we saw during the last couple of months of 2018 was the beginning of a deflationary depression. Mm-hmm. If it had been allowed to continue, we would be back in at least 2008, 2009, and maybe 1932. The Fed responded with basically inflationary talk. They haven't done anything yet, but the implication is that they are ready to inflate away the dollar to the point that we can pay our debts off. So don't worry about your debts. So if they actually make good on that promise, then we're in inflation. Then we're heading for Weimar Germany or Venezuela, or at least the U.S. circa 1978 or so, when inflation was low double digits and interest rates were spiking into the mid double digits. Mm-hmm. So either way, something bad is coming, and it's just a question of the decisions that are made at the top, really, because the debt that we've taken on has its own momentum. Debt is inherently deflationary because when you take on too much, by the way, there's one stat that people should be paying attention to, and that is the almost junk-rated debt out there in corporate America. Mm-hmm. Corporations have been suckered into borrowing so much money, mostly to buy back their own stock over the past few years, and that the amount of debt they've taken on has led to a lot of downgrades. So there's this huge chunk of debt that's rated one step above junk bond level. And in the next recession, next time something happens to slow down the economy and cause corporations to report negative sales instead of positive sales growth, those bonds will all, or at least most of them, will drop down into junk category. And then, those bonds are in pension funds that aren't allowed to hold junk, and mutual funds that would have to sell them, and personal accounts that are supposed to be low risk. And so it'll cause huge turmoil in the markets, and that could be a catalyst for the next financial crisis. So pay attention to trends in the corporate bond market, because all of a sudden that's a big deal. That's yet another catalyst.
Yeah, in fact, you've just written an article, I believe, perhaps posted at dollarcollapse.com today, John. Was it just today or maybe yesterday? What blows up first, part 6, almost junk bonds. That's what you're talking about, right?
Yeah.
This is what could blow up the system first.
Yeah, that's part of a series where I'm looking at the things that could do it, because there are so many, and every one of them is an interesting story. You look at China or Japan or U.S. equity valuations or the Middle East, ongoing war. All of those things could cause a crisis that metastasizes to the rest of the economy because we're so fragile. We've borrowed so much money now that a problem anywhere on a scale that used to be pretty easily handled in a world of mostly decent finances. Today it can spread by knocking down other dominoes into a kind of a conflagration that no amount of central bank monetary manipulation will stop. And so that's the big thing that's probably on the mind of most policymakers now is, what if this thing gets going and we can't stop it? And their solution is to stop it right away. The minute things get a little bit unstable, you jump in, which is what happened with the Fed just lately. They were going to raise interest rates 3 or 4 more times this year. Mm-hmm. And so the stock market tanks, and then they say, never mind. We're not going to raise interest rates anymore. You relax, and if we have to, we'll cut interest rates. So, and the reason they're doing that is because they know we're so fragile that you can't let something progress to the point where it's a clear and present danger, because by that point it might be unstoppable. So these guys are preemptively easing and loosening conditions in whatever way they have the power to do. And it's only going to be quicker over time because they waited a couple of months this time. Next time they'll wait a week. If the stock market drops by 5% a week, boom, they're in the market doing something. And obviously that has a limited time frame in which to operate, because eventually you get to zero, where you just have to operate preemptively without even any problems in the market. You're just liquefying these markets to keep anything from happening. Mm-hmm. And at that point, you get the inflationary death spiral that we know is coming someday.
Oh, it's talk about a hellish situation. I mean, when you think of Venezuela right now with its, inflation rate of beyond triple digits, I think. But in any event, John, then what happens to the debt markets? I mean, it's hard to say how, especially the long end of the yield curve, how can you hold interest rates down if you start having inflationary problems? And why would anybody want to buy long-dated treasuries?
Well, this comes down to the value of the world's fiat currencies. See, if dollars are still perceived to be valuable out there, or euros or yen or Chinese yuan, then the governments of those countries have the ability to manipulate their bond markets by creating new currency and buying bonds. In other words, you buy a bond, it pushes up the price of those bonds. And so you stabilize the market. But as soon as people start to lose faith in these currencies because they see they're being created in absolutely unmanageable, insane quantities, and they start selling those currencies whenever they get them, the price of those currencies fall, and the governments lose the ability to manipulate their financial markets. So right now, they have the ability to put interest rates anywhere they want to. For instance, the Japanese central bank just pegged an interest rate for the 10-year bond. I think it was 0. They said, we'll buy unlimited Japanese government bonds in the open market, priced to yield 0. And they got away with it. But there will come a time when they can't get away with that anymore. And when they do, that's when it's game over. But by then, there will be so much debt in the world and so many overvalued assets out there that the air pockets under every conceivable kind of financial asset will just be immense. They will just gap down all at once, and then it's anybody's guess what happens, because we haven't even talked about politics yet, but a financial world that crazy leads to a political situation that's even crazier. Well, we're heading that way now, obviously, already.
We obviously are heading that way. Before we get to AOC and her crazy ideas and some of the others from the left in the Democratic Party, I want to ask you, you talked about the dollar, and I'm just looking at an article. I think I sent it to you. I don't know if you had a chance to look at it or not. Dollar trapped in negative feedback loop, according to, this is, I think, Morgan Stanley's analysts are concerned that the dollar may be heading into a negative feedback loop, I think along the lines of what you were just suggesting. I mean, we could start to see when people don't want the dollar, and already there are geopolitical issues why a lot of the countries, for the longest time, John, we've been able to live beyond our means in America because the Japanese or the Chinese or others have been willing and able to buy our treasuries. Americans haven't wanted to do it. And we've lived beyond our means. We've gone into debt, increased our debt, and now our federal debt, of course, at the peak of an economic cycle. What are we running? Something like $600 or $800 billion of deficit this year, John. At the top of the economic cycle, what happens when we go down again? I mean,
this is probably what's happening with the dollar right now. Is probably just a squiggle. Prior to something much bigger happening later, but who knows? What's going on now is that U.S. asset prices are down a bit. Mm-hmm. In other words, stock prices have gone down, and the dollar has fallen a little bit from its highs. And you combine those two things, and you get a negative return on U.S. assets, and therefore less demand for U.S. dollars, because you don't need to buy U.S. assets with U.S. dollars if you're not going to get a positive return on them. And let that continue. In other words, let the dollar keep falling and asset prices keep falling. And those two things feed on each other until you get the possibility of a feedback loop that just pushes the dollar down continuously with no end in sight. I suspect right now that this is just one of those squiggles against the other fiat currencies, because remember, when people say strong dollar or weak dollar in today's world, they're talking about relative to the euro and the yen.
Right, exactly.
Pound. And that's not a meaningful measure because all of these things are declining in value. They're just declining in value at differing rates at different times. So the big deal for currencies is when they all start falling against real stuff. In other words, when commodity prices, for instance, start rising all around the world, then that is a global inflation. That is a global decline in the value of these currencies. And when that gets started, that's the trigger point. That might set off the crack-up boom where nobody wants to hold these currencies anymore. I don't think what's happening now is that, because at the same time the dollar's going down, the euro and the yen are going up. So they're just kind of offsetting each other. And in the world of fiat currencies, there is still perceived to be value. That won't last. Someday we'll figure this out, and then it's going to be it's going to be October and November of 2018 on steroids. Those were crazy months, but we're going to see things that make those things look like the foothills on the way to the mountains. It's going to be very different and much scarier than what we just lived through.
John, you're a bit younger than I, but I certainly remember the 1970s, and I was a young adult then working in Manhattan, and I remember the fear that I experienced at that time with double-digit inflation. And Paul Volcker then, of course, was able to come in and slam the brakes on the monetary machine And we had my first mortgage rate was a 17.5% mortgage. We had 14% treasury rates, I believe, if memory serves me correctly. There's no way that can be done now. We can't even let interest rates rise a little bit because it will just trigger a liquidity crisis and a global depression.
Yeah, we think of the 1970s as this big financial crisis, anybody who remembers them. But finances of most countries were actually in pretty good shape back then. We had relatively little debt compared to the size of the economy, and we were fairly productive. In other words, if we borrowed new money in the 1970s and invested it, we generated a pretty good return on it. Today, that's not true. We have immense amounts of debt relative to the size of the economy, and the new debt we take on doesn't generate very much new wealth. So for a new Paul Volcker to come in and say, well, we're going to fix this financial crisis by raising interest rates at 20%, that would destroy the world. Because, as we talked about earlier today, if interest rates go up, that increases all the indebted entities' interest costs. Mm-hmm. So raise interest rates from here, from an average of 2 or 3% to an average of 15%, and you quadruple or quintuple the interest cost of a lot of very indebted things out there. And so you'll have governments going bankrupt and pension funds blowing up and hedge funds just imploding and tons of people who have adjustable rate mortgages or variable rate business loans or credit card debt that fluctuates with the 10-year treasury or whatever. You'll have all those guys being unable to pay their bills and going bankrupt. And so it'll set off this chain reaction that basically evaporates the global financial system. So we can't do that. So we've lost that tool.
All right, John, with just a limited amount of time left here, I've titled today's show, Socialism Provides a Bullish Case for Gold. Now, we've known we're in big trouble long-term anyway with the demographics going the way they are, baby boomers and collecting and not enough people working to provide the revenues to keep the Social Security system, Medicare, and so forth in place. But now along comes this Ocasio-Cortez lady from Queens, where I live here, and she's suggesting that there is no limit to what government can do. There's absolutely no limit, in that we should be out there providing free college, free college education, free health care, unlimited entrance for foreigners to come into the country so they can collect as well. This woman has no idea about limited resources, does she? And where is this going to take us? I mean, is this going to accelerate what we're talking about, the demise and the catastrophe that lies ahead? Someone like this coming along and saying, we got to do all this now?
Well, Jay, do we have 1 minute for me to do some background?
We have 2 or 3 minutes.
Okay, good. We can trace today's politics back to 1971 when Richard Nixon took the world off the gold standard. Prior to that, if a country wanted to do something, they had to actually go get gold, at least to an extent, to do it. So they were limited in what they could do, and they had to prioritize. When we went off the gold standard, it basically handed all the world's governments an unlimited printing press or an unlimited credit card that they could use to spend on anything they wanted to, so they stopped having to prioritize. So now you've got the right in the U.S. We just elected Trump, who massively increased military spending because the neocons advising him want to be able to basically take over the world. They want to be able to fight everybody else in the world and win. That's their goal. And so now we're spending way more on the military than we used to. And that, turning loose the Republicans, emboldened the Democrats. Now they feel free to speak their mind, and it turns out their mind is wildly, ragingly socialist. Mm-hmm. So now their leading politicians have basically dusted off every single spending program that any of their constituencies would like to see. And they're talking about putting them all in a package, giving them to everybody for free, and then, as you said, worrying about how to pay for it later. And the reason they think that's okay is because we've been doing that since the 1970s. We've been able to borrow lots of money and get away with it. So the political class now thinks that's how the world works. They're complete financial illiterates on both the right and the left. The neocons in the Republican Party are just as financially illiterate as the socialists in the Democrat Party.
Amen.
So whoever wins.
Yeah, no doubt about it, John. So the dollar the dollar's days are numbered, no doubt. Do you see it that way?
Yeah. We're in the late stages of the process now, because now whoever wins in the next presidential election is going to run trillion-dollar deficits forever.
Every year.
At some point.
And then multi-triple,
Yes.
and who knows?
Yeah. And see, there's a number out there in terms of the amount of debt in the system that blows us up. We don't know what that number is, but we know we're heading towards it. And it's possible that we're very close. So the faster we go, the sooner we'll get there. And we're about to turbocharge the process.
All right. We're going to have to leave it go at that. All I can say is people better buy gold now while the dollar still buys some of it, because there's going to come a day when your dollar won't buy any of it, any of the real honest money. We'll have to leave it go at that. John, thank you so much for being with us again. You're always welcome and always insightful. Thank you so much.